Hello from Trend Signal for a review of the data and events of the week beginning the 15th of February. Monday, the 15th, first day is actually President's Day. It's a bank holiday in the United States, although all the markets are open. They may have slightly lower liquidity, but it will not be noticeable to most of us. The Chinese markets have reopened after their week-long Lunar New Year celebrations. In fact, the markets were relatively stable. Shanghai, last look, was down just 0.62%. And the main reason being is the comfort given to the markets by the People's Bank of China governor, who said that they regard the balance of payments position as good and capital outflows as normal. And in fact, this on the day that the Chinese yuan appreciated 1.25% against the dollar, the most since July 2005, largely because it's catching up with some of the dollar declines across the board last week. Nevertheless, it's given the markets a bit of a boost first thing Monday morning, with European indices up between 2 and 3% as I talk. This comes despite data out from China over the weekend. If we just go to our Forex Factory calendar, we can see the balance of payments or trade data out from China. On the surface, 406 billion, slightly better than expected, but in fact, that's the only bit of the good news. Chinese exports dropped in January, while imports also fell. The fact is, imports fell further, and that's the reason why the balance of trade has picked up. Exports fell 6.6% in January yuan terms from a year earlier, and that was compared to a 2.3% increase in December. However, imports were also very disappointing, in fact contracting further, a fall of 14.4% year on year, and lower than the forecasted 1.8% growth. So as usual, the Chinese sensitive elements like the Australian market slipped on this export data. The Aussie dollar was a bit sort of erratic, but started to fall a little bit, I think, as traders increased their bets that the Reserve Bank of Australia may cut rates at its next meeting. However, more general risk on this morning as investors re-enter the market, pushing European equities up, as I said, first thing. And the beleaguered Nikkei, which got absolutely hammered last week, falling a whopping 1,867 points. Extraordinary fall. Down 11% last week, but put on 7% following those alarming moves. So it's recovered, sort of two-thirds of it almost. So very, very choppy markets. And this risk on appetite, we can see it affecting other markets as well. So with equities recovering on Monday morning, we can see precious metals, or certainly gold, which benefited from the turmoil in the markets last week, and indeed a fall in the US dollar, really propelling gold $65 higher, what's 5.5%. But that was then, and already this morning gold has pulled back sharply as investors are putting their money back into those riskier assets. So as a temporary hedge against market turmoil, gold did well, but long term, I suspect its prospects will not be helped by a resumption of more normal markets that we've seen this morning. So let's have a look at the data and events out this week. There's a lot of data out, but as always, the focus of our attention tends to be on central bankers, anything to do with central banks and central bankers for that matters, whether it's be speeches, minutes, interest rate decisions, and anything that influences these things has a pretty much direct impact on the markets. And we have two such events happening this week. The first being a speech, or I should say Mario Draghi, the president of the European Central Bank, is due to testify on monetary policy before the European Parliament's Economic and Monetary Affairs Committee. They do love committees in Brussels, don't they? The question is, will he mention QE and possibly increasing it? That's what some economists are suggesting, and there's also talk about lowering the deposit rate further into negative territory. So a lot to sort of consider whether he mentions anything or not that is in market impacting. We will see, but that's 2 o'clock on Monday afternoon. The other central bank event this week, of note, I should say, are the minutes from the Federal Open Market Committee. That's the rate-setting committee for the Federal Reserve. They come out at 7 o'clock on Wednesday evening. The minutes of this January meeting may reveal more concern from officials about the global backdrop and the market turmoil and the fact that conditions have tightened. But because the meeting took place, I think, before a lot of the market turmoil in the last couple of weeks, they may well stop short of talking about any postponing of rate hikes in March or later. But we will find out exactly what they have to say 7 o'clock on Wednesday. And then we have inflation data out in both the UK and US, so referred to as the CPI data out on Tuesday. That's the Consumer Price Index year on year. We call it inflation data. Of course, the concern is that we are fighting deflation, and the markets are concerned that the number is not negative, i.e. is deflation. There is no inflationary expectations or momentum built into these numbers at all. The central bankers are having to fight deflation with extraordinary measures that we've seen in the likes of Sweden, in the likes of Switzerland, and in the Eurozone as a whole, and also in Japan. And the expectations are that inflation is going to remain very, very subdued with all the fall in crude prices and base metals and precious metals, and really commodities in general, for that matter. So we got CPI data out on Tuesday from the UK, and really sort of bookends the week in a way. We then have the US CPI data out at the end of the week on Friday at 1:30, both very, very low numbers, way below what the central banks are targeting. Hence the reason why economists and investors are expecting central bankers to provide even more monetary stimulus to their respective economies. Other data out, we have the German ZEW Economic Sentiment Indicator, a bit of a mouthful, out from Germany on Tuesday at 10 o'clock. Germany being the powerhouse of Europe, as is always described. It's the leading indicator of economic health. It surveyed investors and analysts who are pretty well informed because of what they do, and it measures the change in their sentiment, and which can be a leading indicator of future economic activity. So it is followed quite closely. Needless to say, the number is not particularly inspiring, expecting a figure of plus 0.1, not hugely positive, but we will see what that actually turns out later on. We then have claimant count, that's the unemployment data in the UK on Wednesday. We've already discussed the FOMC meeting in the US. There is some leading inflationary data, as it were, the producer price index in the States, that comes out at 1:30. That is a cost of goods and services, I guess you can call it, going into production. And as you can see, there is no pressure whatsoever on inflation from that side. So not particularly good reading for those central bankers trying to push up inflation, of course. And on Thursday, we have a reading on manufacturing in the United States from the Philadelphia Federal Region. Not a particularly positive number, minus 3.5 the previous month, just improving slightly to minus 2.9, but nothing to write home about. Crude oil inventories, 4 o'clock in the afternoon for all the crude traders amongst you. Dead cat bounces, all sorts of descriptions of what's going on there, but I think the supply continues to pile up, really, and without China and other economies recovering or turning their fortunes around, the prospects for crude are not at all positive for now. And that's really it. Retail sales on Friday from the UK, a modest rebound from the rather surprising negative 1% the previous month. That comes out at 9:30. But that is really it for the week. Thank you very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.